Stock Market Basics, Best Tips for Beginners. Part 1. Everyone knows that you can make a lot of money in the stock market if you know what you're doing, but beginners don't often understand how the market works and exactly why stocks go up and down. Here's what you need to know about the stock market before you start investing. If you're new to our channel, then subscribe and stay connected with us by like, comment, and share this video. Buy the right investment. Buying the right stock is so much easier said than done. Anyone can see a stock that's performed well in the past, but anticipating the performance of a stock in the future is much more difficult. If you want to succeed by investing in individual stocks, you have to be prepared to do a lot of work to analyze a company and manage the investment. When you start looking at statistics, you've got to remember that the professionals are looking at each and every one of those companies with much more rigor than you can probably do as an individual. So it's a very difficult game for the individual to win over time. You'll have to do so much more. Analyze the company's management team, evaluate its competitive advantages, study its financials, including its balance sheet and income statement. Even these items are just the start. Avoid individual stocks if you're a beginner. Everyone has heard someone talk about a big stock win or a great stock pick. Sometimes people have an unrealistic expectation about the kind of returns that they can make in the stock market. And sometimes they confuse luck with skill. You can get lucky sometimes picking an individual stock. It's hard to be lucky over time and avoid those big downturns also. Remember, to make money consistently in individual stocks, you need to know something that the forward-looking market isn't already pricing into the stock price. Keep in mind that for every seller in the market, there's a buyer for those same shares who's equally sure they will profit. An alternative to individual stocks is an index fund, which can be either a mutual fund or an ETF. These funds hold dozens or even hundreds of stocks, and each share you purchase of a fund owns all the companies included in the index. Create a diversified portfolio. One of the key advantages of an index fund is that you immediately have a range of stocks in the fund. For example, if you own a broadly diversified fund based on the S&P 500, you'll own stocks in hundreds of companies across many different industries. Diversification is important because it reduces the risk of any one stock in the portfolio hurting the overall performance very much, and that actually improves your overall returns. In contrast, if you're buying only one individual stock, you really do have all your eggs in one basket. The easiest way to create a broad portfolio is by buying an ETF or a mutual fund. The products have diversification built into them, and you don't have to do any analysis of the companies held in the index fund. When it comes to diversification, that doesn't just mean many different stocks. It also means investments that are spread among different industries, since stock in similar sectors may move in a similar direction for the same reason. Be prepared for a downturn. The hardest issue for most investors is stomaching a loss in their investments. And because the stock market can fluctuate, you will have losses occur from time to time. You'll have to steel yourself to handle these losses, or you'll be apt to buy high and sell low during a panic. As long as you diversify your portfolio, any single stock that you own shouldn't have too much of an impact on your overall return. If it does, buying individual stocks might not be the right choice for you. Even index funds will fluctuate, so you can't get rid of all of your risk. Try how you might. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.